Hello, my name is Jacek Lorek, and welcome to my new show titled From Macro to Crypto. Before I start, let me introduce myself. I am macro analyst with 30 years experience on the market. And 4 years ago, I started my new adventure, my Bitcoin adventure. And especially on-chain analysis became my new passion. And combining my two passions, I mean the macroeconomy and the on-chain analysis, brought me here. Okay, here we go. So let me start with presenting four current macro drivers, in my opinion. First, Chinese stimulus as a reaction on economy rollover. Second, misleading US job market data. Third, US election season and its ramifications for the market. And fourth, Fed issues. Referring to China, I was one of the first analysts who called long on China in mid-September. So you can see the picture of my call. The right upper picture is showing that call, and it was related to the very rare signal I got in early September. And this signal you can see on the left upper chart, and this is related to Chinese 2-year bond yields. Once the yields fell below threshold 1.6%, which is represented by this horizontal green line, we got the signal. The moment we got the signal are represented by green vertical lines. And those signals, it is the third time in history we got such a signal. The first one was in December 2008, the second one in March 2020, and now in September we got the third signal. And when we get this signal, this is a confirmation that Chinese authorities will have to intervene, will have to provide stimulus, will have to react on deteriorating economy. And on this chart, you can also see the Chinese Shanghai index. This is this red line, and green arrows show strong reaction of the stock market following the signal in the past. If you take a look on the lower right chart, which is showing the same index, you can see how strong rally we got just a couple days following my call. 2 weeks later, when Chinese stocks were up almost 40%, everybody got bullish on China. So you can see everywhere that China looks great, it's bullish, it's time to buy Chinese stocks. And I get the impression that this trade got a little bit overcrowded. So I think that correction we got in the last 2 days can be dragged out. But still, I'm still bullish on China, but the price has to consolidate now. The second driver, job market misleading data related to unemployment rate. So you can see popular Jeff Gundlach indicator showing recessions, and that indicator triggers signals once unemployment rate is above its 3-year moving average. As you can see, 11 past recessions were signaled quite well by this indicator. But now this indicator flashed signal 5 months ago, and as we know, we have no recession yet. So this time it failed. And that raises questions, why did it fail? What's wrong with it? Is it something wrong with the indicator or with something else? My answer is, it's all about unemployment rate. Why? Because unemployment rate diverged from a real market job real trend, and this is all due to elevated job labor force immigration, and that causes this deterioration. You can also see the same problem by watching another indicator based on unemployment rate, SUM rule, and this indicator also triggered recession warning after July data. So this is the same problem as we got with Gundlach indicator. So if unemployment rate is misleading, what should we look at to get the better view? My answer is per number job losers is much more accurate and is much more in line with real trend in job market. And using that, I created my own recession signaling indicator. I call it recession forecaster, and it has 4 components. 1, permanent job losers. 2, continued jobless claims. 3rd, truck transportation employment, and Cass-Fraktur index. To compare those completely 4 different data, I use RSIs. Why RSIs? First, to be able to compare data in different units, but there is second, more important reason. RSI is very helpful tool because it's better it's catching change of trend much sooner than the real data. And the composition of my indicator is RSI from permanent job losers plus RSI from continuous jobless claims minus RSI from truck employment and minus Cass-Fraktur index RSI. And altogether, now we have indication which is plus 5.6. And the next slide shows the whole history of this recession forecaster. So when the recession forecaster is below 0, this is a sign of booming economy. Once this indicator is above 0, which is shown on this chart, so the lower red line, it is threshold 0. So once we are above the lower red line, it is first warning signal. But what does that mean? That means that there is no recession yet, but recession of the risk of recession is elevated. And this is exactly when we are now. We are at plus 5 plus 6, but below the middle red line, which is plus 15. When we are above plus 15, so above middle red line, that means that it is likely that we are in recession. And when we are above the upper red line, which is plus 40, this is 100% confirmation that we are in recession. So to summarize, we we have some initial warning, but still no recession yet. And what is most important, in last month, when we had some worrisome data, like for example, July unemployment rate, but also some PMIs and other leading indicators earlier this year, my indicator also reacted on the data, and we were very close to recession signal, but it didn't show recession any single month. So in February we were at +12, close to +15, but we didn't cross that. And in July we was +11, and as I said, now we are at +7. So recession risk is a little bit lower than it was a couple months ago, but anyway, it's elevated. So general conclusions from the previous slide is that there is no recession yet, and this is confirmed by this slide, this chart, and this is showing net percentage of banks tightening lending conditions. So when those percentage of bank tightenings is going down, that is sign of improving economic environment. As we have now, we can see that this percentage is going down, and once this indicator is below red line, it's falling below red line. This is level +11%. So once this percentage is below +11%, it is very bullish for stocks, which I show on the next slide, which is showing S&P 500 52-week performance following the signal. We had 6 signals like this before. First in 1992, the last one in 2021. And you can see that each time we got that signal, S&P 500 was stronger than average. So and it reached the highest levels on average between 30th and 40th week following the signal. So given fact that we got this signal by the end of Q3, we could expect strong market at least another 2 quarters. So by the end of the year, and possibly, hopefully, in the first quarter of the next year. Okay, now the third driver, presidential election season. The first chart I'm showing, it is based on 70 years history, so 17 election years. S&P 500 performance following elections, so since early November till the end of the year, depending on elections result, but in terms of how the power was split or concentrated following elections. So generally speaking, market performed well in election years in last 2 months, but you can see significant difference depending on that outcome. And when Congress control was split, when Congress was divided, which is represented by cases with this green line, the market reaction was the strongest one. And on average, S&P 500 was almost 7.5% higher by the end of the year than on when election, just after election. So on the flip side, the worst market performance was when new elected president could control Congress. So those cases are represented by the red line. And in this case, market performance was still positive, but much weaker than in case of these green cases. And my base case scenario as society is highly divided, which is the global trend, highly divided societies, I expect election outcome with no strong results. I mean, divided Congress is the most likely scenario. So if we get this scenario, probably it will be cheered by stock market. And there is also another conclusion that it doesn't matter who wins. It's completely irrelevant who wins. The only which matters is exactly how the power will be concentrated or split. And as I said, doesn't matter who wins. I would like to refer to the current situation and compare it to the situation 8 years ago. So let's say the common narrative now is that Trump is better for markets. So market expect that if he wins, the market will rally. And in opposite case, there is expectation that market could crash. It is especially a very strong conviction in crypto markets, where, okay, to some extent, it can be rational, as Donald Trump is regarded as a more crypto-friendly candidate. And this is market expectation, but my opinion is it doesn't matter. At the end of the day, it doesn't matter. As I showed on the previous slide, and now I would like to refer to this example from 2016. So in 2016, when we had Trump-Hillary Clinton race, at that time Wall Street. So Hillary Clinton was a Wall Street favorite candidate. Donald Trump was regarded as less welcomed solution for the market. And we could see that once the polls were showing Trump's victory, market was going down. When polls were showing Clinton's victory, market was going up. It exactly happened a couple of days prior to elections. So Hillary Clinton flipped Donald Trump and the market start going up. But the most interesting is just election day. So I'm showing US futures, S&P 500 futures chart, and you can see it was one of the most interesting trading days in the whole history of the markets. Why? Because market was rallying early in the day, and the first exit polls showed Hillary Clinton victory, so that this rally even accelerated then. And later, by the end of the day, as we know, Donald Trump flipped Hillary Clinton and market crashed. So early in the morning next day, November the 9th, US futures were minus 5% comparing to the local top day before. And the whole leading wealth indices were tanking as well. But the closer we were to the market open on Wednesday, November 9th, US futures were bouncing and market opened with much lower gap than it was expected before. And the stock market closed the day at significant plus. And that day, the new rally started, and which was very impressive rally, which was lasted for months. We got the first significant pullback 15 months later, in late January 2018. So narrative completely reversed, which is just a confirmation what I said before, that it was not important who won, it was important how the power was split or concentrated. And referring to my expectations that following elections we should the market rally should be continued. This is also confirmed by this chart, and this chart is showing market performance in terms of the number of new daily record closes in last 10 years. And we can see that the stronger market was between January and early October, the stronger November and December was. And given that the current market is very strong, this year is represented by this thick black line. As we can see, that this is the third strongest year so far in the whole decade. Based on that, we should expect very strong November and strong December. And the last driver, the Fed issue, and this chart is showing repo market rates spreads. So repo market spreads SOFR minus Fed rates EFFR. So generally, repo market rates are close to Fed rates. So that means that this spread is close to zero, is flat. But I would like to point your attention what happened in late 2018 and 2019. As you can see, I showed three events, number one, number two, number three. And let me explain what happened then. So event number one, it was in July 2018. And those spreads suddenly spiked above certain level. I call it first warning signal. This is the lower red line. And it's important that time Fed was in the hiking cycle. So Fed was hiking rates. And this spreads hikes didn't cause any reaction from Fed. So Fed kept going hiking rates, and there was no reaction from Fed. Event number two, it is January 2019, and we got another spike and even higher. So the spread was about the middle red line. And then that caused first reaction from Fed. So as you remember, the last rate hike was in December 2018. And starting from then, we got the Fed pause. So Fed reacting on the spread hiking, stopped hiking rates. It was still continuing QT, but didn't raise rates anymore. But repo market didn't come down. As we can see in spring 2019, we had another spikes. So we have altogether 4 cases when the spreads jumped above warning level 1. And we got another reaction from Fed. So in August 2019, Fed started easing, which means they lowered rates for the first time. by 25 bips. They still continued QT, but they lowered rates. But the problems on repo continued, and we got the event number 3. It is mid-September 19, and then the jump was huge. It was about 5. So the spread was about 5%, which is something absolutely incredible, and that caused immediate reaction from Fed. So New York Fed started providing liquidity to the markets. And interestingly enough, Fed officially said that they are continuing QT, but in reality, it was QE, which I will show on the next slide. So on the upper chart is showing Fed balance sheet in 2019 and 2020, as you can see. So prior this repo crisis, Fed balance sheet was going down, and it just started bouncing day after this repo crisis. So I call this period Fed stealth QE, because Fed didn't admit that, but at the end of the day, they were doing QE, which of course accelerated during the COVID crisis. Anyway, we got so repo crisis has caused real Fed pivot, and I will make step back just to show this again this spread chart, just to show that after 4 years flat spreads, we got the first spike again. After 4 years, we got the first spike. It was 10 days ago, and honestly speaking, this is the first signing signal, the same what we got in late 2018. And that raises the questions: will Fed react immediately, or they will wait? It's premature to say what Fed will do, but based on last week's data, and if we take a look on Fed's current balance sheet, the lower chart, we can see it was flat. So it didn't go down, and I'm curious what will happen next week. So it's definitely worth watching and see what is the final reaction from Fed. Will Fed terminate its QT or even start new QE, or it will continue QT? Okay, let me show you another indicator. This is indicator, I call it S&P 500 macro top indicator, and this indicator is showing major stock market tops. As we know, when you get the market key blow of top, volatility is going up. Volatility measured by VIX index. So VIX is one of key components of my indicator as well. But spiking volatility is not enough to get the blow of top. We also need spiking credit spreads, and credit spreads are second component of my indicator. And by the way, many analysts say that there is no way market rally to be continued due to elevated VIX, which in fact is elevated. But on the flip side, credit spreads are on the historic lows. A couple of days ago, credit spreads fell below 3 3%, which is one of the lowest levels ever. So that combined doesn't show that market is ready for any significant pullback or crash. So as I said, we have VIX, we have credit spreads, we have 2-year bond yields. As we know, bond yields are correlated with stocks, especially in the easing cycle as we have now. So it is third important component of my indicator. And the last component is permanent job losers, because to get the blow off top, we need some first signals of weak job market. So altogether, I have 4 components. And similarly to my recession forecaster, I use RSIs. So the final composition of my indicator is RSI from VIX plus RSI from credit spreads plus RSI from permanent job losers minus RSI from bond yields. And the current indication is 96. And the next chart is showing the history of this indicator. And you can see here S&P 500. This is the black line and the left scale. And this indicator is violet line and the right scale. But note that this right scale is inverted, which means that if indicator is going up, on the chart is going down. So, and to get the signal of blow off top, this indicator in reality has to be above 110. Just to remind you, now we are at 95, almost 96, but still it's some distance, some gap between 96 and 110. So, in other words, we get the blow off top confirmation once the violet line is below red line on this chart. So, no confirmation of blow off top yet. Another chart, the yield curve, and the red line is the current yield curve, and the green line is yield curve from mid-September. Why mid-September? Because on September 14th, it was the time when it was the most extreme bull steepener of yield curve, and starting from then, the bear steepener started, and we have very fast moving bear steepener. See yields now comparing to yields 1 month ago. So so the red line is much higher the green line. Generally speaking, bear steepener is bullish for stocks, and bonds bear steepener is the signal of the maturing stock market rally. So bear steepener is followed by blow off top of stock market blow off top. We had similar situation in late 2019, early 2007, 1990, to some extent, but not exactly in 2000. So all that together shows me that it's bullish for stocks in the short term, but it's also signaling something bad in the mid to long term. The next chart, it is TLT chart. So if we given conclusions from the previous slide, we should expect bond price to crash. Bear steepener, rallying stocks, so bond yields to crash. But if we take a look on TLT chart, so TLT long-term chart, it is the left chart. For me, it looks quite nice, I have to admit. And in my opinion, the pattern TLT is forming, it is cup and handle pattern, which is very bullish. Once we break out from this pattern, TLT chart should explode. But I also showed the same chart, but in the smaller time frame. So we still have some room for consolidation. And how can I explain the bear steepener, rallying stocks, and bullish looking bond charts? Sorry. So my explanation of this is as follows. As yield curve is suggesting that something bad, something big and bad is brewing in the future, bond prices are starting to discount that threaten, and this is a reason that they are not crashing. So when the stocks are running, bonds are consolidating. So 90 plus prices of TLT as we have now, in my opinion, it is short-term buying opportunity. 100 plus prices are taking profit opportunity, and I think this should be continued for the next month, because I don't expect TLT to break out before we get the final blow of top. The next chart is showing 10-year and 3-month bonds yield spread. And this is very important for me. It's the same, it's as much important as 10-year and 2-year spread. So everybody knows that 10-year and 2-year spread uninverted, but we still have very deep negative spread in terms of 10-year and 3 months. And it will have significant ramifications for both for economy, for the market, but I will continue that by the next slide. And here we go. This is the most complex chart I'm showing today, but the most important one. So let me explain this chart. So this is, I merged 3 charts to one. So the upper one, it is my macro top indicator, so S&P 500 macro top indicator. The middle one, it is the 10-year 3-month spread chart, and the lower one is my recession forecaster. But let me start with the upper chart, so S&P 500 top indicator. We got 5 blow of top signals in history of this indicator, and those moments are marked by these vertical lines. But you can see that 3 of them are red and 2 of them are orange. And what is the difference between them? And here we can also we have to look at the middle chart. So to get the major recessionary blow of top, we need 2 conditions to be met. First, violet line falling below red line, which still didn't happen yet. And the second condition, we need to get negative spread on 10-year 3-month yield. And if 2 conditions are met, we have major tops. When we have just macro top indicating market top. But if that signal is not following inverted yield curve, and these negative spreads are represented by these red rectangles. So you can see on the middle chart these red rectangles. So to get the major blow of top, we need violet line below red line and the red rectangle in the same time. If violet line is below red line but no rectangle, as we had in July 98 and in July 2011, so these are these two cases with orange lines, we also had some signal, but it means something different. So even following that signals, market had significant pullbacks, but they were short-lived. So in both cases, market crashed 13, 14, 15%, roughly speaking, but it was 2-3 months pullback and that's it. And there was no recession following the signal. So referring that to the current situation, we have first condition met, which is this red rectangle. By the way, the size of this rectangle is also something worth to mention, because you can see that this rectangle is much bigger than rectangles in previous cases. But I will continue that when I will discuss the lower chart. So first condition is met, and second condition we are still waiting for, just violet line to be below red line. And now I would like to go to the lower chart, the recession forecaster. So to get the recession, we have first recession forecaster, the black line, to go above middle and ultimately upper red line, which still didn't happen. And this should follow red rectangles. So we have red rectangles. One condition is met. Second condition is not met yet. And also, I would like to say that if you take a look on 2007 case, this rectangle was much bigger than this from in 2000 and this in 2020. So my conclusion is that the longer yield inversion, the longer in time and the deeper yield inversion, the more severe depression following the signal. So having said that, if we take a look on the current rectangle, it's showing that something that really something big, something bad is brewing, and probably my guess is that the future recession we are heading to will be the toughest one, the most severe in our lifetime. Why I'm saying that? Because the red rectangle we are having now, it was only one moment in history when we had something similar, and it was in the late 20s of the last century. So the Great Depression and the biggest crash in stock market history followed yield inversion similar to that we have right now. So to summarize all this macro stuff, we have, so the length and the magnitude of the yield curve signals bigger crisis, upcoming bigger crisis. Second, the fiscal stimulus, which is unprecedented, has prolonged this business cycle. It's longer, much longer than one might expect. And labor market doesn't show enough weakness to expect immediate recession. So we are going that direction, but still we have some room to go. In my opinion, we need another 2-3 quarters economy to fully roll over. And in the meantime, some indicators which are improving, especially lagging indicators, which will react what we are facing right now. For example, falling unemployment rate probably will show, they will strengthen soft landing narrative. And in my opinion, it will be a big trap. It will be tricky for many investors, and I think everybody should be cautious due to that. And to summarize traditional market, there are numerous signs that stock market rally should be continued. It's related to the improving lending conditions. It's related to the presidential cycle seasonality. It is related to the smashing credit spreads. And it is also related to the bear steepener. Bear steepener is also indicating that stock market rally should be continued. From the other hand, we have bond market, which doesn't suffer as it should. So as it should do. So altogether, it's confirming that bond market it's starting discounting something, but which will happen in the future. And now I will jump to my second topic. So the crypto story, and this chart is showing how MicroStrategy outperformed Wall Street darling stock Nvidia. So you can see MSTR is the best performing stock on the market at the moment, and it's definitely higher than it's more impressive than the one made by Nvidia. It is very relevant for me, and let me explain why. And here you can see MSTR long-term chart, and as you can see, we had multi-month consolidation represented by these converging white lines, and in the last 2 weeks, MSTR has broken out from this consolidation, and it is very strong, very clear breakout. It's suggesting further rally, and this is very significant if we take a look on BTC chart, since BTC is still in similar consolidation to consolidation of MSTR, but BTC hasn't broken out yet. But MSTR case is showing that BTC breakout is just a matter of time. Why? Because MSTR tends to front run what BTC does. MSTR breaks out or breaks down are sooner than that ones of BTC. MSTR tended to make major tops sooner than BTC, and the same with the bottoms. So this breakout is very positive for BTC prospects as well. BTC short-term price, short-term chart. This is 4-hour chart. As we can see, BTC has broken out from the short-term pattern, reverse head and shoulders. And the target of this breakout is almost 68,000. And I'm recording this material on Tuesday, and this chart is Tuesday early European hours of Tuesday, and I just drawn the target of BTC breakout, but it's already done. So when I'm recording this material, BTC already hit this target I expected it would. And in the same time, BTC price entered resistance zone. So this shaded pink rectangle, this is BTC resistance zones. And in my opinion, the further upside potential, short term, I mean short term, matters of days, is limited. And the pullback is more likely than that further upside, but only in very short time perspective. I'm very bullish midterm and long term, and I think that this short term rally is probably over. As I said, I'm very bullish midterm. I say bullish on BTC, and my conviction is confirmed by this chart. This is one of the most important on-chain metrics. This is Bitcoin value days destroyed multiple, VDDM, and this metric signaled major tops quite precisely. So we got these tops confirmation once this indicator turned red or brown. I don't know what color you can see, but this is the darkest color. In my chart, it is red. So it was, let's say, there were top signals. But on the flip side, when this indicator turned green, as it is now, it was very good long-term buying opportunity. And not only long-term, but this indicator also was quite useful to signal BTC gaining momentum. And once this indicator turned from green to orange, that were moments that, as I said, BTC gained momentum and the new rallies started. Those moments are marked on this chart by these green circles. But you can also see that some of the circles are not green, they are blue, as the current circle. What is the difference between the blue and the green circles? So the blue circle is when you get the buy signal, as we got 3 days ago. So we got the buy signal on VDDM, but we need also the second condition to be met, and the second condition is a halving event. So combination of VDDM buy signal and halving events, those moments are marked with these blue circles. And the next slide is showing BTC behavior following those blue circles. As you can see, once we got the blue circle, BTC rally started almost immediately. I mean, almost immediately. It was just a matter of 1 to 3 weeks when the rally started. So having said that, we got 3 days ago the first blue circle, and probably early November should be the latest time frame when the new rally should be resumed. So if we know that BTC is poised to rally, there is a good question: how far can it go? And here I'm showing my another tool Bitcoin price log extension from its 350 days moving average. 350 days SMA is very important moving average for BTC, and you can see that when BTC was reaching major tops, those extensions represented by violet line, I've forgotten to say that BTC price, it is black line and left scale, and extensions are this is violet line and right scale. So you can see that those extensions were forming trend line or trend, I would say trend channel. So when BTC was forming those major tops, this extension was entering this channel represented by these two lines, the lower one, the yellow line, and the upper band, the red line. And if we know the trend, if we know where 350 SMA is, we can extrapolate or calculate what is the Bitcoin cycle top market cap, price cap. I'm sorry. So, and this is represented by this red yellow color band. And if we take a look on the current numbers, the lower band is at 97K, and the upper band is 118K. But you have to keep in mind that this moving average is going up, and probably by the end of the year, the lower band will be around 110K, and the upper band will be around 130K. So 30K. So that means that the most possible BTC cycle top price based using this method is just around 120K. The next chart is showing my another tool. This is my hash rate BTC model. What you can see that BTC price, it is thin black line. Hash rate model price, it is thick black line, and the violet line, it is BTC logarithmic extension from the model price. And you can see that by each major top, those indications reach this similar level, and this level is within this red rectangle. So that is confirming that BTC didn't reach the final top yet, as this extension didn't enter this red rectangle. And using the same method, we can also extrapolate BTC target price, and this target price is between 112K and 160K. Comparing that to the previous slides, we get confluence just around 120K, and that confirms that 120K is the most likely BTC target price. My last tool I'm showing, that is my secret weapon, BTC on-chain algorithm. As you can see, all the buy signals, these green rectangles for this year, and all sell signals, the red rectangles. I'm not going deeply into details. If somebody is interested, just visit my profile on X. Just would like to point your attention how impressive ROIs this algorithm generated. So each year this algorithm was available. It was available starting from 2021. All returns were highly positive. The same algorithm for ETH, and the same entry price and selling prices, and the statistics, and the statistics is even better. is so altogether compound ROI for this algorithm for these 3.5 years is 20,000%. It's really impressive. Just to summarize, crypto market. Near-term future is promising. Global liquidity is beneficial for cryptos. On-chain data is showing accumulation. Technical outlook is bullish. The only we need is trigger. This trigger, in my opinion, will be elections outcome. And I think the new president, regardless Republican or Democratic, will change White House policy about crypto. So thank you for your attention. I would like to invite you for my X profile. Then you can find more information. You can find the link to my profile below description. And once again, thank you very much, and hopefully see you and hear you again. Bye.